In this third part of topic 4, we move on to the third section, which is the definitions of the regulated activities that appear in the Securities and Futures Ordinance. So 10 regulated activities. Let's just go through the 10 definitions. Will this come up in the exam? Well, all 10 will not, no, but some will. This is material that does appear in the exam. So we start with activity 1, dealing in securities. And the first thing we are faced with is a definition of securities and derivatives. Now, it's the Securities and Futures Ordinance. Almost anything that's traded is a security except futures, which are futures. And if we look at the wide range of instruments that are included in the definition of securities, shares, stocks, debentures, rights, options, interests in those instruments, certificates of interest, interests in collective investment schemes. Now, a collective investment scheme, a mutual fund, a unit trust, interests in those are also seen as securities, and there are a few others that are much broader listed. Moving down the bullet points, we note that the definition specifically includes definitions such as options and warrants. So those are considered securities. So traded options on the stock exchange are securities. Whereas options on futures are considered to be futures. That is because options and futures are traded on the futures exchange, while options on securities are traded on the stock exchange. So remember, options and futures, as far as the definitions are concerned, are futures. So what is the definition of dealing in securities? We're told it's a bit wordy, and it's highly unlikely they'll examine this exact wording. A person deals in securities if he makes or offers to make an agreement or induces or attempts to induce another person to enter into an agreement for acquiring, disposing of, subscribing for, underwriting securities, or for the purpose of making profits from securities. So it's really what we all understand intuitively, but a lawyer has had to put it into words, and that is what is considered dealing in securities. It has to be as part of a process of making money, making profits. But there are exceptions to the definitions. What that means is that the definition is fairly broad, and it maybe catches parties that were not intended to be regulated. And so we carve them out through this list. So recognized exchanges, clearinghouses, and authorized automated trading services, no, they do not need Type 1 license. Person engaged in dealing in securities as defined above through a licensed securities dealer. No exception if for remuneration. What that's saying is this covers retail investors. Retail investors who are buying and selling securities through a broker, they don't need the Type 1. However, if they do it on behalf of someone for remuneration, they're carrying out the job of being a broker, and they would need Type 1. Persons acting as principals with a professional investor. That is, you are representing the professional investor. A classic would be working on the proprietary trading desk of a big bank. If that's all you do, you're not trading on behalf of clients, you're trading for the principal, then technically you do not need Type 1 license. Issuing of prospectuses and forms of application for shares with prospectuses, those activities, no, you don't need Type 1. Issuing of an advertisement or invitation authorized by the SFC, trust companies registered under the trustee ordinance, and certain types of 4, 6, and 9 activities. That's advising securities, corporate finance, advising, and asset management. The first 2 or 3 are the ones that tend to be examined in the exception. More chance of an exception being examined than the general definition of dealing in securities. And then at the top of page 4.21, we're introduced to the classic categories of persons that do hold a Type 1. Stock exchange participants, whether or not engaged in stock exchange activities, other securities dealers where they're carrying out dealing, licensed representatives. The first 2 are the intermediaries, and then the third one are the individuals that are carrying out the trading. AFIs registered with the SFC, obviously, if they're involved in securities dealing, they'll hold Type 1. Any portfolio managers who are licensed for Type 1 regulated activity will also hold the type 1. And a securities introducing agent, now this is a very specific category. It was introduced in the financial resource rules. And an approved introducing agent is someone that acts as a go-between, introduces a potential investor to a dealer, but that's all they do. They do not handle client assets. They incur no legal liability. It really are just a go-between introducing investor to dealer. If that is the case, first of all, you have to hold a Type 1 license. And secondly, if you're approved by the SFC, your financial resource requirements, your liquid capital level is lower than the required liquid capital. That's the point of it. But please be aware, although I'm told there are not many approved introducing agents around, regularly examined. It would be one question in the exam, so be comfortable with the concept of approved introducing agent. Okay, that was the material on Type 1, dealing in securities. We now move on to Type 2, dealing in futures. And this really mirrors a lot of the material for Type 1. So we have a definition of a futures contract and a futures market. Well, rarely examined. Just be aware, futures contract is a standardized forward contract that's traded on a futures market. Definition of dealing in futures contracts, top of page 4.22. Well, it's really somewhere, I beg your pardon. It is dealing in the contracts that have been introduced earlier. The exceptions from the definition are listed there, very similar to the Type 1. I'm glossing over this because the definition for dealing in futures is not regularly examined, whereas dealing in securities, yes, more common. Leverage foreign exchange trading, again, not core materials, Type 3 activity. It's over-the-counter OTC, and this is where you will have two counterparties trading with each other with these leveraged foreign exchange contracts. And we have given you some details from the notes. 2 points I would highlight. AFIs. So further down the page, AFIs do not need to be registered to conduct Type 3. They are well regulated by the Hong Kong Monetary Authority, so the SFC is not going to worry themselves with regard to banks that are trading foreign exchange products. And the last point, if a client requires a dispute between him or herself and a licensed trader to be settled, must be settled by arbitration, and that's specifically covered in the Securities and Futures Ordinance. Now we come to some more mainstream definitions. Advising on securities and futures contracts, Type 4 and 5. We're given a definition of advising, the giving of advice, the issuing of analyses or reports to allow recipients to make decisions on the buying and selling of those securities and futures. Again, we have a list of exemptions. These people do not need to hold Type 4 or 5 licenses, and some of them we've seen before. Solicitors, counsel, legal counsel, professional accountants, trust companies, and those holding Type 9 licensees, asset managers, licenses, I should say, but they give advice wholly incidental. The wording wholly incidental, extremely important. Financial journalists and broadcasters, surprisingly, they influence the market to a great extent, but they do not need to be licensed. Corporations giving advice, issuing analyses and reports to wholly owned subsidiaries. We saw that in topic 3. They do not need to be licensed. And then Type 1, Type 2 licensees, where they're giving advice wholly incidental, there's the wording again, to their dealing activities. We come to Type 6 and Type 6, advising on corporate finance. What does that mean? It means giving advice compliance with the listing rules and the codes and takeovers and mergers and everything that goes with that. And we've listed the legislation and the codes that corporate finance advisors have to heed. But topic 8 will explore the world of corporate finance advising in a lot more detail. Type 7, providing automated trading services. Now, I touched on this in topic 3. Under part 3 of the ordinance, you have to be authorized. That is the likes of NASDAQ making its system available to Hong Kong investors. Type 7 license is all about in-house proprietary trading systems. The second last bullet point on page 4.23 covers this. Trade confirmation and matching systems provided by brokers. If you run such a thing, top of page 4.24, part 5, you must be licensed, registered to provide that service as a regulated activity. The Type 8 license covers securities margin financing. Now, we have a definition of securities margin financing. It's basically lending money to investors to enable them to invest and hold listed securities. And those listed securities can be listed on any stock market. It doesn't have to be just Hong Kong. Once again, we've exceptions to the definition. Be aware the main exceptions: Type 1 licensees, traders who are lending to their dealing clients do not need Type 8 licenses separately. The Type 1 will cover them because they're suitably regulated by the SFC. And AFIs, that is banks. Banks can lend money to their clients for whatever reason, and they are sufficiently regulated by the Hong Kong Monetary Authority. So the SFC doesn't require the AFIs to also hold Type 8. So one or two other exceptions there that you should be aware of. Now, what's the big deal about Type 8? Well, Type 8 license is given to someone usually who is not regulated elsewhere, is not a bank, is not a dealer. And the SFC want them to behave as if they were a bank. And so listed under the conduct requirements for securities margin financiers is all the practices that you would associate with a banking institution. And I'll let you read through those. Margin agreements with regard to securities margin financiers. We list what such agreements should cover. Moving on to the Type 9 activity of asset management. Asset managers are regulated by a number of ordinance, Securities and Futures Ordinance, Mandatory Provident Fund Schemes Ordinance, ORSO, Occupational Retirement Schemes Ordinance, and the Insurance Ordinance. We have a number of definitions of asset management. Real estate investment scheme management, one category, and then securities or futures contract management on the other side. Securities and futures contract management by far and away the most common in Hong Kong. We certainly have REITs and they're listed in Hong Kong. But the securities and futures contract management, the managing of a portfolio of securities or futures contracts. Now, with regard to asset management, we're told at the bottom of page 4.2, securities include interests in collective investment schemes, and that's the most common for asset management, mutual funds, unit trusts. But does not include, the definition of securities does not include any interest in a registered MPF scheme, occupational retirement scheme, contract of insurance. And you may say, well, why not? They sound like collective investment schemes. Yes, generally, I would agree. However, they are regulated by separate ordinances, the Mandatory Provident Fund Schemes Ordinance, ORSO, and the Insurance Ordinance. And that is why technically they are not defined as securities under the Securities and Futures Ordinance. Top of 4.26, we look at the functions of the SFC for the world of asset management. They authorize collective investment schemes that are being made available to the public in Hong Kong. That's one of their major tasks in the world of collective investment schemes. They will supervise collective investment scheme marketing and license and supervise intermediaries. That is the Type 9 license engaged in asset management. The Type 10 activity, providing credit rating services. That's, as I've said before, the world of Moody's, Fitch, S&P. Have a read through the definition of credit ratings. It's put into, again, words as to what most people understand. It's usually debt securities, bonds, securitized debt that they will give ratings on to help investors decide on the risk of investing in such investments. Those were the definitions of the 10 regulated activities. Now we just have a few other points at the end of topic 4. OTC derivatives. we have a set of rules on the reporting. And I've listed the main headings that appear in the study material. What would I be aware? I would be aware that you report your over-the-counter derivative positions if they are significant to the Hong Kong Monetary Authority. Under 9.4 on page 4.27, we're told all transaction information must be reported to the HKMA via the Hong Kong Trade Repository electronic reporting system, and it's operated by the HKMA. You're reporting to the HKMA because it's a liquidity issue. The HKMA want to know where all the big OTC derivative positions in Hong Kong are, because potentially they could cause problems for the liquidity of the markets. But it's only sizable positions that they're interested in. So under exemptions, paragraph 9.6, Lice Corporation is exempt from the reporting requirement if the notional amount of all outstanding OTC derivative transactions within the specified product class does not exceed 30 million US dollars. So if you have OTC derivative positions under 30 million US dollars, you don't have to report. But as soon as you exceed it, you lose that exemption and you must continually report your OTC derivative positions to the HKMA. Then the second set of rules has been issued in this regard, and that is with regard to mandatory clearing. There's the full title, top page 4.29. And you have a mandatory clearing obligation for an OTC derivative position if it's particularly large. And we can see under 10.3 products subject to clearing obligation, if you look down to the second bullet point, as the regulatory objective is to catch systemic risks posed by larger and more significant participants in the derivatives market. The clearing rules only apply to positions of 20 billion US dollars or more. Well, that is extremely large. It's very difficult to find anyone in Hong Kong who's actually been involved in this. I'm often told it's dealt with by London or New York. Nevertheless, we do have the legislation in Hong Kong that if you have an OTC derivative position in excess of 20 billion US dollars, you're subject to mandatory clearing of that position. Lastly, under topic 4, relatively new open-ended fund companies. Please read through that information. It's the creation of a corporate to run an investment fund and the different operators of it. A major point that I would highlight is you cannot go and incorporate such a company. You must go through the SFC. So first point under 11.2, prior to incorporating an OFC, an application must be made to the SFC identifying directors, investment manager, and custodian. And then it says the incorporation will be undertaken by the registrar of companies. However, it's the SFC that will implement the registration. Okay, that is the end of topic 4. You may have picked up topic 4 is a bit of a beast. There is a lot of information in there, and regularly it has the highest number of questions posed in the exam. A lot of detail in there that you don't come to intuitively. You just have to be aware of how things operate in Hong Kong. As ever, the best way to solidify your understanding, go and do the practice questions on Examinator.online. By getting them wrong, listen to the audio explanation. You will get closer and closer to having the sufficient knowledge for the exam.